Hi, and welcome back to Hedge Fund Manager. I'm Karl-Mikael, and today we're doing a deep dive into Kaspi. And now it's time to summarize the case for Kaspi. So what we have is a really deep value company. It's a dominant player in the region, and it's also expanding geographically. It's a fast grower, currently with a guidance of 15% earnings growth for 2025, excluding its acquisitions. And it's valued at just slightly below 7 times next 12 months earnings. So it's cheap, it's growing quickly, it's a dominant player, it's a light asset player since it's an online company, it's a super app, so it has everything going for it. So why is it so cheap? Why has it come down from 144 all the way down to 80 and now bounced to about $87–88 or so? Well, the reason is that as they are trying to digest these large acquisitions, the growth has faltered slightly, and they reduced their EPS growth guidance from 20% growth to just 15% growth. Well, as you can tell, it's still a high growth company despite this slight reduction in guidance. And on top of that, the absolute no-no for a company that has been a reliable dividend distribution company with a 8% dividend yield. They cancelled, or rather paused, their dividend at the March 31st annual general meeting. So I think that is what really put a brake to the stock price, and dividend investors are shunning the company because of that. And the company has not really been able to say when they plan to resume the dividend, but they have only said that they are pausing it for now, but they actually might even resume it by the end of 2025. So I definitely expect, given their economics, that they will resume a dividend, and they will do it pretty quickly, and that will be a positive trigger for the share price. And maybe that's actually what we're already seeing, as the stock price has bounced about 10% from the bottom this summer. So there is a brewing positivism or optimism around Kaspi, and that could be the reason could be that the dividend will be resumed. We can see here, for example, how the earnings per share forecast for 2027, it was actually increased just slightly before this AGM meeting, and then after that reduced. Well, it looks dramatic in this chart, but as you can see, it's only down from about $18.25 per share and down to now about $17.25. So it's just $1. It's a 5–6% downgrade in terms of earnings for 2027. Really a year we really don't know that much about. Between now and then, we'll see them use all the potentiality in their Hepsiburada acquisition and Rabobank, etc. So it's really just a scrapping of the dividend and a slight reduction in future earnings. So let's look at what did they actually say in their first quarter numbers. Well, they still have a high growth rate in everything. Expect the net income for their fintech section, but this is pretty normal. And their consolidated growth rate was still 16% year over year in the Q1 report, and they then reduced guidance to 15% earnings per share growth rate for the entire year. I would say that that's probably unnecessarily cautious, but it's really not there that this case will be decided. It's rather the years after that. We can also see here how the slight loss for their Turkish acquisition hasn't, well, it has of course affected the growth rate, but this is still not a major part of their total operations, and it's definitely under control. And what we'll likely see over the coming quarters and years is how they use their normal modus operandi to make that profitable and get back on growth track. And here is the guidance. This is what's behind probably the turmoil for the share, is that they reduced the guidance from around 20% year growth rate to around 15%. So sure, it could be below, it could be above. They have a history of usually beating the guidance every year. So possibly this is actually actually an unnecessarily cautious guidance. Coming to the actual return summary for this stock case, the usual is that we try to calculate the CAGR, total annual return rate for every investment. So it's the fundamental variable, the valuation variable, and the dividend variable. And currently, I would say, currently for 2025, the guidance is just 15% EPS growth, but I would say that even 15 to 20% for the coming 4 years would be probably a too pessimistic forecast. As we can see, consensus is actually still at between 15 and 22% per year. And I would say that this is not really taking into account the potential that they have in expanding the scope of their business and really using the total number of eyeballs that they have acquired in Turkey. In terms of the valuation part of this equation, if we add 10% per year to the CAGR, then that means a plus 46% revaluation over 4 years, and that would take it from 6.8 times forward-looking PE to an even 10x forward-looking PE. I actually asked my own TIC ChatGPT agent what it thought about this, and not surprisingly, it says that a company like this should probably be valued at twice that level, at like 20 times earnings, because of the high growth rate. Unfortunately, we will probably never see that in Kazakhstan in our lifetimes, but that doesn't mean it's not worth that much. And actually being undervalued, constantly undervalued, is why we can get such a high dividend yield, which we can keep putting to use in the stock. And then we have the dividend component. Can we expect 5% or maybe 8% going forward? I think they will get back to 8%. Because simply they don't have to use that cash, and if they want to use it, they will use it for acquisitions, which probably is even better for us. But the total sum of this comes to 20% plus 10 plus 5% in kind of a cautious scenario. That would be 35% annual returns for us as investors. So the problem here is what could go wrong, what are the risks involved? Well, I think the risks are mainly imaginary. People are afraid of the closeness to Russia, and it's simply that a weak stock price could be a signal. So it's a question of not really wanting to buy something that's not already working. But I would say that those are more imaginary risks than real risks. So I still maintain that this is a really, really deep value company with a lots of positives and very few negatives. So this is definitely a strong buy.